Will there be a crash or will it just be a correction? Well, Lee Kearney believes that we will definitely have a crash coming up in the next couple of years, and he's got the exact exit strategy to help you get through that with flying colors. If you want financial freedom, time freedom, and want to leave a legacy for generations to come, you probably have heard real estate investing is the place to do that. How do you get started? What do you have to do? When's the right time? If you are looking for those answers, you've come to the right place. My name's Kyle Stanley, and this is Fearless Flipping. My mission is to help you learn this business and conquer real estate investing. Hey guys, welcome into the Fearless Flipping podcast. You're here with me, Kyle Stanley, and as I always promise, we are going to get to our first shout out before we get into the podcast with Lee Kearney, which is going to be an awesome one. He has got one exit strategy for you that he believes, among all others, if there's a crash, that you can survive a crash, and not only survive, but thrive during a crash when it does in fact come, which by the way, he says is inevitable. So we're going to go ahead and give a shout out. First of all, again, if you listen on the podcast or the YouTube channel, as long as you comment with some sort of value or you comment or review on the podcast with a review that tells us exactly what you're learning, you are going to have a great opportunity to get your name mentioned. This one's from JC Pinto. He says, a must-listen podcast. I started to listen to the podcast recently and has a lot of great info about real estate investing and in general, or if you even want to scale your Airbnb business. Thank you, JC. And speaking of which, if you haven't checked out this link right here, I'm pointing on the YouTube channel. If you're not seeing what I'm pointing to and you're listening to the podcast, it's fearlessflipping.com/Airbnb host. We have an amazing page that is showing you exactly what you need to do to start a real estate investing slash Airbnb business. Now, if you want to get started in Airbnb, you need to check out this page, but you also need to do two things. Download the calculator, the profit calculator that we have on there. It's awesome. It will help you to be able to evaluate your Airbnb deals better. And number two, make sure you apply for our Airbnb Kickstart Masterclass, which is starting on February 10th. It's the first of its kind. We've only got 4 spots left available. We're capping this thing out at 12 people. And what I really would love for you to do is just apply, get your questions answered by me if this is the right fit for you. And then I'm going to turn around and see if you're the right fit for the group, because we're looking for very, very motivated people who want to start an Airbnb business and not only start it, but master it, automate it, and scale it. So once again, fearlessflipping.com/Airbnb host to get started in an Airbnb business. Now let's go ahead and jump into this interview with Lee Kearney, who's going to give us his number one exit strategy to survive a market crash. Hey, welcome into the show with Lee Kearney. He's from Ireland originally, but coming in from Tampa, Florida. Lee, thanks so much for being with us.
Thanks for having me.
Awesome. CEO of Real Advisors and also CEO of the Spin Companies. And Lee, I got to ask, as usual, our very first question to every single guest: what is your most interesting or your weirdest real estate investing story?
Sure. So about 3 years ago, we purchased a property the day before it was going to tax deed sale. Now, we'd been negotiating with this seller for several weeks. He was an older gentleman. He lived on the property in an RV that probably hadn't been maintained in 10 years. So just a very, very bizarre situation. So we'd been negotiating with saying, hey, you're going to lose your property. You don't want to do this. We can get you some money. So finally, he comes in the day before the sale. He signs a deed to the property. His friend was a witness, by the way, on the deed, witnessed him sell the home. We agreed a bunch of terms. We had to move quickly on getting the taxes paid and getting the deed signed. Well, actually getting the deed signed so we could pay off the taxes. And then we had a whole list of things we're going to do for him. We're going to list this house. We're going to give him money to fix up another house. We could get more money. I mean, it was a really good deal. So Next day, waiting for the guy to come into the office, didn't show up.
Oh, gosh.
Waited the next day, didn't show up. About 2 weeks later, got a letter from an attorney that said that we had fraudulently induced him to sell his home. He didn't know what he was signing. And so we were like, oh, geez. So we said, well, here's his valid Florida driver's license. Looks like he drove here. Looks like his friend signed the deed. Looks like we listed out. We showed him the addendum with all the bullet points of all the money he was getting. He said, not quite sure how he didn't know he was selling his home. Found out the attorney that had sent us a letter wanted to buy the property. So,
oh, gosh.
I know, it's bad. So, you think about like the worst case scenario. So this battle went on for 2 years on
Oh,
this property, 2 years. And I got to kind of so how it all ended up, instead of the seller getting a bunch of money, it ended up that the seller got, I think, $0, and all of my attorney's fees were paid for the money he was supposed to get. So I felt horrible about the situation, but I also felt horrible that we'd shelled out money and someone was accusing us of something we didn't do. So
yeah.
I guess there's a couple lessons out of there. Is it funny? No, not really. But I say this to everybody: do good business,
Yep.
keep good paperwork, and if someone does challenge you, you can stand up for yourself. So it's always going to be my last approach on a property. But in this case, we've chosen to do good business. We've chosen to be honest with sellers, and we've chosen to have good paperwork. And we had all three of those in this case. And that's why finally they folded their tent. But it literally took 2 years for them to say, okay, we'll drop it.
Jeez.
Yeah.
If I were the seller, I'd be firing that lawyer for getting emotionally involved in something that he shouldn't have been involved in. That's ridiculous.
Well, there was definitely alternative motives here. And there's a lot of people don't realize this. Just because you're an attorney doesn't mean you're a good person. Just because it's a title company doesn't mean they're legitimate. And so, a contractor with a license, they're all different. Same thing with doctors. You can have 5 different doctors. And I know this from neck surgeries, from knee surgeries. They're not all the same. So, do your due diligence, good business, good people, good paperwork, and then you have nothing to worry about.
Exactly. All right. Well, thanks for sharing that story to kick this off. Guys, this is a very big honor that we have Lee on the show today. Just to give you a little bit of background, Lee has, in the last decade, flipped over 7,000 homes. His company has done over $500 million of business, which is incredible in itself. But what I'm really excited about to talk about today, and here's one thing that I think people need when it comes to real estate. They need black and white. They need to not hear the gray. And it's in just literally 10 seconds of even talking to you before we started here, I knew that you were going to be that black and white advice giver. And for that reason, I think you're going to help out a lot of people that are listening today. So the big topic today, market cycles. Give me your mindset right now. Here we are in January of 2020. What cycle are we in, and what should people be doing? What are you doing?
Sure. Well, first of all, I'll give you some background on this. So I've been studying market cycles ever since I lost everything 12 years ago. So I've had to become an expert because I never wanted to lose everything again. So I'll kind of lead off with that. Yeah. And thank goodness I learned those lessons and have excelled since then. But what I realize is market cycles exist. And my first experience with that was 12 years ago, actually 13 years ago, when I realized my entire portfolio was upside down, that the rug got pulled out from underneath me, equity was gone, negative cash flowing properties, couldn't buy more properties, couldn't make a profit, margins compressed, selling stuff for less than what you bought, and realized the show's over. So I've seen it firsthand. I've experienced it. And so I chose to really study market cycles and understand what's going on. I also chose to surround myself with mentors that have been through several market cycles. And so by doing that, now am I the authority on it? No, but do I have a lot of knowledge regarding it? I absolutely do. And so I look at statistics and trends and numbers and try to just put common sense to it. So there's things that happen at a national level. There's things happening internationally. You've got the stock market, you've got the real estate market. And what you'll find is a lot of this stuff is related. It's to do with the beginning of the debt cycle, the end of the debt cycle, which means at the beginning of the debt cycle, lots of money is pushed out in the market. At the end of the debt cycle, people start defaulting, people have to start paying it back. And that's when everything kind of goes full circle. And so you've got the recession linked in with that. You've got economic highs and lows. There's lots of things that are intertwined in that. So when I stand back and look at today's market, and just to give you 2 general statistics that are fairly accurate, if you take Tampa and Las Vegas as 2 bellwether markets, and they're considered by most statisticians as being bellwether markets, kind of like representative markets, for lack of a better word, what you'll find is that 10 years ago, the median price in Tampa and Vegas was in the 80s, right? Wow. Now, 12 years ago, probably not 12 years ago, about 13, 14 years ago, the average price was about $250. So it
Wow.
went from 250
Yep.
down to 80s. You want to hazard a guess of what the median price is today in both markets?
I'm going to guess over 250.
Yes.
Yeah.
So this is where I stand back and look at this. I can't ignore stuff like this.
Mm-hmm.
I just went to an institutional conference, and rather than talking about appreciation, they were talking about doing analytics and using AI to predict if a tenant was going to pay rent or not. I mean, at this point, if that's where you're at with your rentals, the show's over. So you can present me arguments till you're blue in the face about how good your strategy is. And we spoke about this briefly before this show. The buy, add value, and refi. Buy, add value, refi. I will say that that's a decent strategy if you're buying at wholesale, because at least you have a margin of error built in.
Right.
However, what that doesn't account for is the liquidity is gone. When banks get scared, things turn the other way. They stop lending money. So that's where multiple sources of capital really, really kick in. So yes, if you're buying at wholesale, you got multiple sources of capital. I can see a dollar cost average argument making sense. The problem is, for most people starting out, they're not buying below market, they're buying at market value. Yep. And that strategy runs out real quickly with a 10-20% shift in the market, because there is no refi opportunity. You can't even pay off your bridge loan. You're just stuck. And for those of you asking what a bridge loan is, typically most investors will take a bridge loan to stabilize the property, which is anywhere from, we'll say, months to a couple of years. And then they'll refi out of that bridge loan into long-term financing, which is typically 5 to 10 years. And I recommend to everybody, you want to ride out a market cycle, make sure it's 10-year plus debt, especially with where rates are at right now. It makes a lot of sense to lock in long-term debt. The problem with a 5-year rate is you can get caught in the middle of a down cycle. You can't exit, which means if the bank calls the note due, you're stuck. You lose the property because there's nowhere to go. You're upside down on the property, or there's not enough equity for anyone else to refi you out.
Yeah, so, and a lot of these hard money lenders that are giving 1-year notes, and you've got a flip, and your thought is, hey, if anything goes wrong with this flip, I can go ahead and refinance it and make it a rental. Well, like you said, market crash happens, and suddenly you are on a 1-year note. What are you going to do?
Well, that's it. If you don't have a solid amount of equity, you either A, sell the property at a discount, or B, you got to find some private capital that's willing to ignore the value of the property. What I found, though, from my 15 plus years experience at this point, is if you can't sell the home, everything's kind of upside down, and you force it to be a rental, you're taking on a negative cash flowing rental. If the property doesn't work and you paid too much for it, you're going to end up forcing it to be a rental, and it's not going to work. It's going to negative cash flow and end up being a liability rather than an asset. Mm-hmm. So it really goes back to buying properties right, making sure you have a defined exit that makes sense, make sure that you're looking at the market cycles. And this isn't meant to scare everybody, but if you're asking yourself, what should you do right now? If you're in a market that's had rapid growth, and you can look at people want to know, well, how do I know this? Do I have to study macroeconomics? No. Type in a market, type in Zillow, Tampa market. Go to Zillow and you'll see the exact trend. Go back 10 years, you'll see this, you'll see this, and you'll see this. It doesn't take rocket science, a lot of common sense. Now we got a presidential race coming up this year, the change of leadership there. There's lots of things happening. If you actually look economically, we're at that 10-year cycle. It's about time for a reset. The stock market as an all-time high. Tesla crossed $500 yesterday. I mean, I'm just looking at just crazy things going on right now. And everybody wants to say, well, unemployment's low. I'm like, well, that means the only place for it to go is back up.
Yep.
The stock market's an all-time high. In my mind, the only place is to go down. Real estate's at an all-time high. Yeah, I'm scared to death. That means the next thing's coming down. So people that have really educated me on this is they take you beyond looking at what's going on today, and a lot of common sense kicks in on where things are going tomorrow. And even just taking a step back at the economy, there's one word that drives an economy. This was taught to me many, many years ago. It's spending. So what I look at when I'm looking at my monthly check-in on the State of the Union, I look at consumer spending index. You're seeing cracks in the armor there. I look at the manufacturing index. Why? Because manufacturing shows what's happening with the consumer confidence. So let's just say people go from changing their car every year to every 3 years. That'll trickle down to manufacturing because they're not manufacturing as many cars crossing the line. It's all connected. So I
So
just try
what,
to.
if I'm listening to this right now, sorry to interrupt you, Lee. If I'm
Sure.
listening to this right now and I'm saying, okay, spending in manufacturing, but what am I looking for at that? If I wanted to pull over to the side of the road right now, I'm listening and I want to Google spending, I want to Google
Yeah,
manufacturing.
consumer confidence index would be one, and the
Okay.
manufacturing index, and you'll see that there's cracks in the armor in both of those indexes for sure.
And how am I finding those cracks in the armor? What exactly am I looking for in those?
I'm looking
numbers?
for going down. So in
Got it.
simple terms, if people are not as confident, what happens to people who are not as confident? They close their wallet.
Mm-hmm.
When people are confident, they open their wallet. When people open their wallet, they spend. Spending drives an economy.
Mm-hmm.
And so what you're seeing is unemployment, confidence, spending, manufacturing, defaults. It's all connected. It's all connected. In fact, if you can Google it. There's 20 different places that publish this information. If you're looking for hotspots for defaults right now, I'm going to tell you something real interesting. You're going to see it up north around, Maryland. You're going to see lots of defaults. You can see lots of defaults in California, see lots of defaults in Florida. It's already starting to heat up. And anyone who's arguing with that is ignoring facts.
Got it.
I'm not predicting a world crash. I'm simply pointing out that there's major defaults starting to ramp up month over month, especially on the West Coast and the East Coast. And that's typically where it is. If you look at the cyclical markets, Florida and California bleeds over into Arizona. Nevada. This is all history repeating itself.
Okay. Well, like you said, Lee, we're not doing this episode to make people be like Chicken Little and go say the sky is falling, but right. We are going to provide some solutions here that I think is going to really help people get past some of that fear. But before we do, I think we jumped into this like really quickly. I do want to back up for a second. I want to hear more about your story and kind of take me before 2008, maybe you getting into real estate. What were you doing around that time? And lead us up to where you said, hey, you ended up turning upside down. I want to kind of hear a little bit more about what led to that turning upside down. And and I've got a backup question for that too. So let's start over there.
The rise and the fall.
Yeah,
absolutely. So back in 2003, I was working an industrial sales job. I bought a penthouse. When I say penthouse, it sounds a lot more than what it was. It was about $250,000. This was in Dublin, Ireland. Got broken into literally a couple weeks afterwards. The kids were just ringing all the different buzzers, and whoever didn't answer, they realized wasn't home, so they broke in. Just crazy stuff. So I felt completely uncomfortable. And funny side note on that, I couldn't get a new door because it was a custom door. So we boarded it from the inside, and the only way I could get into my condo for a week was to get out on my balcony, climb up on the roof, crawl across the other side of the roof, and get back into a common area and go down the elevator.
Oh my gosh.
So for a week, I was running over the roof. Yeah. What's that?
You probably never wanted to leave the house because of that.
Oh, it was the worst. It was so embarrassing. I was literally climbing across the roof on the penthouse of this condominium building. So anyway, sold it, made about $35,000. And that's when the light bulb went off for me. I said, I just made more money from this than I did in my job, base pay before commission. I did it by accident. So that's when I was bit. At that point, I just, it just got me. I said, I got to do this. I have to figure out how to do this on purpose and how to repeat this. So I'd moved out to California in 2004, and I found a coach. I wouldn't say he was a mentor, but definitely a coach who showed me how he was flipping houses. I helped him pick up materials, go to his job sites, understood where he bought, what price he bought, how much money he put into it, and how he priced it. That made a lot of sense. So I had this little formula: buy around 130,000, buy in this grid, put in 15, 20,000, sell for 180. That sounded pretty doable for me. So I said, no problem. It took me 4 months. It took me 4 months to find my first house. I found that it was a probate. I didn't even know what a probate was, by the way. I just knew that I had this little old lady who was a realtor finding me a deal, and it was around 130,000, and I was in this grid. And that was, there was no home, no nothing. I just bought the house because I was told to buy it. So I bought it, borrowed hard money, used some of my own cash that I'd made from the condo, made every mistake under the sun, electrocuted myself, screwed up the plumbing, broke the windows, had an antenna almost take my arm off when I was pulling the pin out. You know those
Yikes.
old antennas on top of the house?
Yeah.
I pulled the pin out. I didn't realize that one pin, the whole thing was like a telescope, and it almost took my arm off. So
Oh,
yeah, crazy, crazy stuff. It was all strapped, 4 straps. It was right in the center of the roof. Crazy stuff. Anyway, did exactly what I was told, put signs in all the major intersections. I remember I put on the open house and I'm sitting there going, I hope this works. I
yeah.
had about 50 people come through that house that day.
Wow.
And I'll never forget it. This guy, Jose Chalet, still remember his name, says to me, I'll take it. I said, okay. And then I'm calling my agent going, how do I do a contract? So anyway, a couple of days later, we got a contract. And the day before closing, there's disclosures in California. We have to disclose if someone died. The previous owner had died. It was a probate. So the buyer freaks out. So Jose Chalet calls me on the phone and said, Lee, I got one question for you. My crap, this is the day before closing. It's my first real paycheck. Like, what's going on? He goes, are there ghosts in the house? And I remember saying, Jose, I've lived in this house. It's absolutely 100% ghost free. And he bought the house. So it was a huge win. But yeah, that was a defining moment. It was like, man, is my first flip going to fall apart?
Good for you. I would have been like, are you really asking me this question? So good for
No, it was
you
do or die. This was all the money I had. All the money I had was tied up in the home, and any money I was going to make was tied up in that home. So yeah, I had to close it. So did my second flip in California, moved back to Tampa, made some mistakes, by the way. Tried to have a friend rehab it, disaster. Tried to remotely rehab, disaster. So there are things not to do. I asked a lot of questions. So what I'd say to folks out there, ask questions. There is no dumb question.
Right.
And for me, I got a lot of time and energy for people that ask me questions. I'll get people hit me up on Instagram and Facebook, and the typical question I get is like, where do I go? What do I do? How do I get started?
Mm-hmm.
And so I try to be nice about that stuff, because I remember asking a lot of those questions and people probably like, what the heck, man? I was asking, what's a foreclosure? So my friend's father was buying foreclosures, and I browbeat him into telling me all the things to do. So finally end up at the courthouse steps with a few $1,000s. I think at that point, probably had a bankroll of say 50 grand, because I'd had a couple flips and was living really, really small. Now there's a whole bunch of numbers being auctioned off. So there's a live auction. It's like a poker game, because everyone's winking and nodding, and I have no idea what's going on. All I see is numbers being sold, numbers being announced, more numbers being sold. I'm like, what the hell's going on here? So finally realized that someone sold a book turning the numbers into houses. So now I had a roadmap. I'd drive the houses in the morning, go bid on them in the afternoon. And within a couple of years, I became one of the biggest buyers in Hillsborough County. I was woven into that world.
Just from auctions?
Just from auctions.
Wow.
And I was between bootstrapping credit cards, Bank of America gave me a line of credit as soon as I got title. I was up to several $1 million in real estate in 24 months.
Do you think auctions still work today?
That's a great question. So we've really backed off of auctions today. The reason being is we're finding with the supply of money that anything that's on market, including auctions, is being flooded with dumb money. Mm-hmm. One of my mentors described it best. He goes, as the market increases, at the end of the cycle, that's when the masses of asses come in and the dumb money. And that's when the show's over. So I'm finding that everywhere I look for on-market deals, it's just dumb money, stuff that doesn't make sense. They're not buying the properties commensurate with the risk. Margins are too thin. There's a lot of risk of buying a foreclosures. You got title issues, you got objections to sale, cancellation. You got lots of things that can really bite you. And so
I do want to say one thing, Lee. When I first started out, and I'm 100% on board with you with that, I've honestly gotten to the point where I don't even look at the MLS anymore. I do have some people that are friends of mine that are investors here in town that have gotten great deals from the MLS, but they're, you got to literally be searching all day long to be the competitive one. So let me back up for a second. I learned how to really evaluate and to analyze a deal from the MLS in the beginning. So even though I don't buy from the MLS, I did in the beginning get on the MLS or on some version of the MLS, Zillow, Redfin, every single day, look at properties and just continue to try to analyze them with my eye, with the ARV and everything. So I still really encourage people, and I want to hear if you think the same thing, that if you're not going to buy from the MLS, that you still, if you're just starting out, use it as a way to start learning how to evaluate and analyze deals.
Absolutely. I think it's a great idea. You can paper trade and you can look at what stuff's selling for. You can track what they did with the property. Ultimately, it's a fixer upper. It's probably going to go down one of three paths. It's going to be a homeowner that wanted a great deal, which is less. It's going to be an investor that keeps it as a rental, or an investor that adds value and flips it. And you can determine that fairly easy if it's a fixer upper bank owned property. But I do think it's great because you get to look at pictures, you get to see pricing. And just like you found, we found that the pricing just doesn't make sense. I mean, case in point, if you're here in Hillsborough County, stuff is going at 70 to 80 cents on the dollar before CapEx, which means if you're trying to buy something at 70 cents, including rehab, you're kind of out in the cold, because that's the starting bid before rehab, which means stuff is really, really not making sense. And that's why we've shifted. It's funny, things have gone full circle. Back in 2006, as well as auctions, we were doing a lot of seller direct. We've gone full circle right back to that. We're dealing directly with homeowners. The only thing that's changed is that more of the data is online and it's easier to do it. So we're really dialing up that seller direct platform. We're looking for great sellers, great equity. And case in point, last week, 2 deals. This is fresh, beginning of the year. We closed one deal that'll net over 100,000 from one home.
Wow.
Another deal about $50,000. So by spending a lot of time on tracking down the right sellers with the right kind of equity, we're definitely crushing that side of the business, but we're not crushing it on auctions because the effort to return ratio is not there. And in simple terms, if you take supply and demand, if there's 50 people, which is not uncommon, by the way, on a great deal that's listed on the MLS, it doesn't matter if it's listed 50 grand below market value. This is where people get confused, going, oh, it's on the MLS, it's a great deal. I'm like, wait till all the offers come in.
Exactly.
What'll happen is the magic hand of capitalism kick in, supply and demand kicks in. If there's a bunch of demand and supply is limited, the price will get to an equilibrium point, and it'll go over market if there's excess demand, which is what we're seeing, especially when the banks make you hold the listing for 7 to 10 days. All the offers come in, the offers get ridiculous, and the show's over.
Hey, Fearless Flipping community, we are taking a quick break from the podcast to talk about Airbnb. For those of you that don't know, I have built much of my residual income around Airbnb, despite a lot of other investors being really excited about long-term renters. I was not. I saw an opportunity with Airbnb to get to my goals faster, to get more cash flow, and to pay off my houses quicker too. So instead of being really happy like a lot of other investors are with $200 to $300 of cash flow every single month, I've turned my renters and rentals into over $1,000 on average of cash flow every single month. So if you want to learn more about Airbnb, my systems, where I pick my Airbnbs, how I communicate with guests. Maybe you've already got Airbnb as a business on the side right now, but you want to take it to the next level. I am absolutely here to help you. You can book a free consultation with me about Airbnb. Learn more by booking at fearlessflipping.com/consultation, and you get me for 30 minutes for free. That's right, 30 minutes absolutely free. And that's, once again, fearlessflipping.com/consultation, and I'm looking forward to helping you conquer Airbnb investing. Well, and again, I want everyone to know that we're getting to a solution here, but I do want to fast forward. So you've gotten to this point where you're one of the biggest auction buyers in your area. Again, we're going back, 10 plus years ago.
Correct. 2007.
2007. Yep. And so you said something early on in the show that when 2008 hit, you flipped upside down.
Yep.
What created that, and what would you do differently if you were to rewind the clock?
Great questions. I had an upside down portfolio, which was negative cash flowing rentals. Sounds dumb, but it was a reality of my situation.
Was that because of vacancy, or why was that?
When I couldn't sell a house, I decided to keep it as a rental.
Mm-hmm.
And so it never made sense. I mean, I had 8% loans, and I had $800 payments and $1,000 rent.
Got it. I mean, so you had all these properties that you intended to flip, but you had to hold on to them because they weren't going to sell, and now you're making negative cash flow.
So the first wave of my demise was when the market started to shift. instead of unloading the house, which I couldn't because the debt was more, I was able to get a high appraised value because the appraised value was going off historic comps, right? So the comps in this case were higher than the current value. So I was able to get a high appraisal, cash out, keep the property as a rental, but the debt was so high on it that I couldn't cover the debt payment. So I'm negative cash flowing on a dozen properties, a couple $100 a month. Then my flips, I'm now selling them for less money than I bought them for before fixing them up in some cases. I mean, things were really in free fall.
Yikes.
So I found myself, I ran out of cash. Now I'm left with a negative cash flowing portfolio that I couldn't service. So right around the end of 2007, I had to stop paying everything. I was done. Now, the good news for everyone out there, I learned really valuable lesson. In fact, there was two of them. One, there's always money in real estate. The X factor, though, is being on the right side of the trade. I should have been wholesaling and passing that risk on to the buyer instead of buying these things from wholesalers. So let's take a real example of being on the wrong side of the trade. A wholesaler would sell me a house, make 20 grand. I'd buy the house, fix it up, and lose 20 grand. Who was on the right side of the trade there?
The wholesaler.
Clearly, it was the wholesaler.
Yeah.
So the money was made on the exact same house that I lost money on. I had just positioned myself incorrectly. So all I did, you talk about solutions, I decided to not be a rehabber while the market was in disarray, be a wholesaler, pass the risk on to the buyer, tie up contracts, and assign them before I closed on them. And so essentially I was selling before I bought. That took 100% off the risk from me. And the good news for everyone out there, it may sound a little doomsday-ish, I made about $1 million my first year after changing strategy.
Wow.
So
that's amazing.
It was easy. It was just a shift. It was a shift in mindset. And as we spoke about before the show, once I realized I was back in making money again, I'm looking at the same properties I had sold 2 years previous for $150,000 that I could buy at the courthouse steps for 20. So then I started buying a rental portfolio again at bottom prices. So this is where my market cycles kick in. If you're in a cyclical market, wait. Don't buy at peak value when you can buy it 60%, 50%, 40%, 30%. I mean, who knows exactly where it's going to land? What I do know is economics 101 kicks in. If there's less demand and there's excess supply, that forces the price down. That's a fundamental fact of economics, but how far that'll go, I don't know. The only thing that's different this market cycle, big difference, is there's a big supply of money. However, the supply of money today is not indicative of the supply tomorrow. Because at the end of the day, if the people providing capital to the market have a lot of defaults on their books, they're going to have to pull back their capital. So that's where the argument that's posed to me is that the capital today means it's the same capital tomorrow. And my argument is as reserve rates change and as defaults kick in, you're going to find that there's less money in the market. It all works in tandem. Prices go down, the crap hits the fan, less lenders, less money, lower prices. It's just where that's going to land. But I want to be poised, whatever that opportunity looks like, to be able to capture and buy rental properties at multiples that make sense.
Okay. So you're saying get into wholesaling right now because that's where you see the market going. Now, you did mention earlier on that where people are getting in trouble is that they're buying either close to market value or at market value. What about the people that are doing the burst strategy, which for our audience, we talk about a lot. For those new people out there, it's essentially buy, rehab, rent, refinance, repeat. If the margins are there, if you're getting something at a great wholesale value, is it still a viable method?
Yes, it is, because of what you mentioned. There's one key thing you mentioned that's different. If you're buying it right. The big key to all of this stuff, where it ignores market cycles in some ways, is on the buy. If you buy it at a rate that makes sense and not at market value, where market value kicks in is in two places. If the market's high and you buy at market value, you've paid too much. The converse is true though. We could have picked up properties off the ground 10 years ago because it didn't matter what you bought. Even at market price, the multiples were ridiculous on rentals. You'd buy something for $50,000 all in that you could rent for $1,000. Now the same house has about 150 multiple on it. And it's extremely hard to cash flow, which means for $1,000 in rent, maybe 150 is high. It's at least 100, 120 is what we're finding in most markets. $1,000 gets you 100. It's $100,000 property to generate 1,000 a month. And for most investors, it's going to be hard to cash flow over several years on one house. And you've just compiled your problem. If your debt payment is too high before all of the other expenses you have on rentals to actually cash flow.
Got it. So I'm going to ask a question, and this could turn into maybe some healthy debate.
Sure.
With a lot of my audience, they know that Airbnb is one of my main exit strategies.
Sure.
Now, Airbnb is a little bit of a different rental strategy than a long-term rental strategy. Now, you mentioned in 2007, or 2007, 2008, 2009, right around then, when Airbnb really was just starting, that wasn't in existence for you. So you were negative cash flowing. One of the things that I talk about with my audience is that, let's say a recession hits, or let's say a crash hits, we have, because we're evaluating these Airbnb deals to be, if rent or mortgage is $1,300, then we should be cash flowing at least $1,000 to $1,500, which gives us this great gap here. Now, in that case, knowing that those kinds of margins are there, would you suggest, or would you be a proponent of Airbnb as a backup strategy if people are stuck with houses that are now negative cash flowing for the future?
It's a great question. There was actually a lot to unpack in that, but I'll try to give you a succinct answer on that. So going into buying a property with an Airbnb strategy, I would highly recommend not doing that. I'll give you an example from Hillsborough County. Hillsborough County in Florida just banned Airbnb nightly rentals. They're completely banned. So there's got to be 7-night minimum. And even then, if you advertise it, but then they find out that you're renting it nightly, so you advertise a week, but will take less, they're doing $5,000 a day fines on that. So it's important to understand the local municipality and the rules. What I'm finding is that the nightly rental in a nice neighborhood is starting to get shut down by local municipalities. That's what they don't want. That doesn't mean there's not weekly and monthly rentals that make sense, especially for people coming in and contract work close to hospital, close to a school. You got to think about close to a new construction site where they're bringing in contract work. So I think that the niche works very well, but what you got to consider is the sustainability of that. And so that doesn't mean, I don't believe that strategy on one house is going to work for 10 years. So I always want to underwrite the rentals on the basis of it going back to market rent for the asset, where I think you can absolutely increase your rental, your net, is by taking advantage of something that makes sense. Yes, if you've got a high demand area for short-term rentals, why would you rent something for $1,000 a month when you can gross $3,000 a month and net $1,500 to $2,000? It would be crazy. The highest and best use for that property, in that case, as a rental, would be renting it short-term. So go ahead.
And what I was going to say is you hit it on the head. So my strategy with this is always, it needs to work as a regular rental at the end of the day. Right. If it doesn't make sense to do, which is also why I implement a strategy that a lot of people know about, which is basically, it's called a mother-in-law hack, where we can either get a second unit on the property or turn a garage into a second unit so that we have one mortgage, but two flows of cash flow.
Bingo.
So in that case, if we do this as an Airbnb, even if we buy at market value, okay, in Fresno here, we can I just actually helped a client get a house for $210,000 that has 2 units on it. That means their mortgage is $1,250 a month. They're right now grossing right around $3,000 a month with Airbnb, which is awesome. But let's say Airbnb gets shut down. Let's say that, something happens where the market gets affected greatly. Well, that front unit, let's just call it $1,000 a month. Let's call the back unit $500 a month. You're still cash flowing because you've got 2 cash flows on one property. Does that make sense?
It does makes a lot of sense. And in fact, just so you don't think I'm poo-pooing short-term rentals.
No, yeah. Like I said, healthy debate.
I just bought a rental for $785,000. It's tax assessed at $2.1 million. We're putting $200,000 CapEx into it, $150,000 in furniture. So we'll be right into this asset for about $1.15 million. The rental on a monthly basis, and what we're using this for is displaced insurance clients on luxury properties, is about $30,000 a month.
Wow.
As a regular 1-year lease, the rental is between $15,000 and $20,000 per month.
Wow.
And renting it out on a weekly basis and for special events, we're going to gross about $40,000 a month. So
That's great.
just so you know, I engaged that strategy, but it's on very unique property. This is a very unique property in a luxury neighborhood that sits right outside the HOA restrictions. So I don't have an HOA to deal with. It's in the county and not the city. And it means there's not going to be noise issues. So we beat up the numbers every which way. And this property of 1.1 million will cash flow approximately low teens to actually mid 20s net, depending on which strategy we use. So we beat it up every which way, and it makes a lot of money.
I think the common theme we're talking about here, no matter what strategy you're using, is to mitigate the risk. And as many times as possible, as often as possible, you're either eliminating or passing on that risk to someone else or to a very strong exit strategy, which I love. So we went off on a tangent there. I like talking about that just to get a little conversation of Airbnb going. But I do have a question. You've mentioned many times now wholesaling. How should people, if they're right now thinking, man, I was thinking about doing flips, but now I'm listening to Lee's podcast here, and I'm just really wondering, well, how do I get into wholesaling?
Sure. Well, wholesaling is actually fairly easy. So if you've bought a property right, the best way to test that is put it out to your local investors. And if they'll buy it for more money than you paid, you got a good deal. I would argue if you can't even sell it for what you paid it, what did you see that no one else saw? You probably didn't get a good deal. So this is where wholesaling really puts honesty on how good of a deal you got. And truly, if you can wholesale something, it means you got a great deal. It also means you've got options to analyze wholesale versus retail, and then what's going to make most economic sense. The one thing that people ignore from retail is what they think it's going to sell for versus what it actually sells for. They also ignore what they think it's going to cost to rehab versus what it actually costs. So the additional risk of a rehab versus wholesale is market risk, rehab risk, and resale risk. So you've got 3 risks that you don't have with wholesale. Wholesale, if you bought it, contracted it, you sold it for X, and you're collecting the difference, that's a set number. When you take on a rehab, you're essentially rolling the dice that you are going to sell it for what you think it's going to sell it for. The market's not going to go down, and that your rehab cost is going to stay in budget. And those 3 things, well, the resale price is what it is. And a lot of that's dependent upon your analytics being right in the first place and the market not shifting in between your buy and your sell. The rehab cost, unless you're very experienced, and this is why I don't recommend people do this right out of the gate. Wholesale a house, do it, transact real estate, buy and sell, but do it without any risk. You're better off collecting 5 or 10 grand instead of taking on one rehab and losing 20 grand because you learned all the mistakes on that. And furthermore, you talked about paper trading. If you're selling to a rehabber, you already wrote down your number. Have a look and see what they sold it for. You'll get a real good idea of where your analytics are compared to the reality of where the asset will actually trade. And so there's lots of ways to mitigate risk. Owner financing with no recourse would be one. Wholesaling is number 2. Even commercial lending or getting institutional lending with no recourse, which is harder to get on single family assets. Great ways to mitigate risk. So I would just strongly recommend you don't jump right into doing something with a whole bunch of variables. Because if you think about it, rehabbing involves buying a house right, which is one skill set, understanding market value, which means you got to be a market expert now overnight, number 2, and now you got to be a construction expert, number 3. You've actually made your job 3 times more difficult by taking on a rehab as your first house versus a wholesale deal. And I hate to say this, if you've contracted something in good faith with a good inspection period and you bombed on it, you at least have an exit of getting out before your inspection period's up, so you can then retrade again and try to buy a similar asset at a lower price or even renegotiate with that current seller. You can kind of put on your training wheels with wholesaling. You're going all in when you actually take down an asset with debt with the exit of selling it at a higher price.
Cool. All right. We got about 2 minutes left. I want to give people an opportunity to connect with you
Sure.
and to also learn more about Real Advisors.
Absolutely. Absolutely. If you want to go to realadvisors.com, you can learn more about our educational platform. If you want to connect with me on Instagram, it's Real Lee Kearney. That's Kearney. Again, Real Lee Kearney. And you can also check us out on Instagram at Real Advisors. So I'd love to connect with you guys. If you want to learn more about me and what we do as a company, be happy to connect with you.
And just a quick 30 seconds, Real Advisors educational platform in what sense? There's courses out there, there's
Sure.
one-on-one coaching. How does this break down?
Sure. Yeah, we primarily focus, we've got two main courses we focus on right now. One, which is Real Mogul, which is actually a course taught by me. We're going to be transitioning that into a partnership opportunity, which means that people get to partner with us, do deals, and it's a great way to do your first few deals and have some help doing them and partner with an experienced operator. Then we also have Commercial Empire right now, which is a fantastic platform. It's taught by Tim Bratz, over 300 million in real estate holdings. And he breaks it down how to buy your first deal and how to put that on steroids and how to just create that legacy wealth that everybody really wants, not only for them and their family, but the generations after them.
That's great. I didn't know you were with Tim. He was on our show about 2 months ago.
Yeah, Tim's a rock star.
Yeah, he is. And we still keep in contact.
Awesome.
Lee, thank you so much. Is there any last words that you have for our listeners just as we log off here?
No, just I would say that it's the beginning of the year. A lot of people are setting their goals. Goals are great, but your daily habits are what's going to create your success. So make sure you make your goal, you create a plan, but most importantly, execute. So execute. And my last piece of advice is focus. Don't try to execute on 10 strategies. Pick the best one, focus, go all in on it, perfect it before you try to move on to something else.
Awesome. All right, everyone, go check out realadvisors.com. Connect with Lee on Instagram. And Lee, thank you so much for helping our listeners to conquer real estate investing. So if you've already gotten started in wholesaling, you're in a great position. But if you want to get started in wholesaling, make sure to go to our show notes for Lee's episode here, which was fearlessflipping.com/Lee Kearney, LeeKearney. That's going to wrap it up for this episode of Fearless Flipping. Check us out later in the week when we're talking more about Airbnb. And if you haven't already checked out that page, make sure you do, to not only get our profit calculator, but apply for our masterclass, which is starting on February 10th of 2020. We've only got 4 spots left available. It's fearlessflipping.com/Airbnb host. Go check it out and go out there and conquer real estate investing.